past the top of the hour, and I want to welcome you all at Pax8 for joining us this afternoon. We had a great session this morning, and we get to present again for those of you that are on this call this afternoon. Group, and my business partner Ian Campbell is also on the line. We're going to be presenting in tandem today. Alpha Capital Management Group, our firm, we're financial advisors, and we are assigned to your 401k plan to help with your 401k. Our role is primarily twofold. We meet with with Pax8 at a corporate level to make sure that the investments in your 401k plan are being managed, and we always have fantastic investments in there. We monitor them on a quarterly basis. Sometimes you'll see there's changes that are being made with investments being swapped in or out. That's, again, our primary role is to make sure that the mutual fund menu that you have in your 401k plan is outstanding. Of course, we know your 401k as being with Voya Financial. That's our provider. That's where you log in to see your accounts and look at your balances grow and manage your investments and input your beneficiary information and all of those good things. So Voya has been a great partner. They're a fantastic. We're happy to be associated with them. So today we're going to be talking about investing in times of uncertainty. And Ian and I are going to present for about 30 minutes, and we've got a ton of information that we want to share. We think this is going to be very beneficial for you and to make sure that some of your questions are being answered as it relates to 401k, and it should be super helpful. So in this presentation, there is a chat button where you can ask questions. In the meantime, if you do have a mute button, we do ask that you put your phones on mute to keep the background noise at a minimum. So with that being said, we'll get started and talk about investing in your 401k and investing in times of uncertainty. So the first thing we want to talk about is what are the current factors that could affect your investment returns in the short term. We're going to have a lot of information that talks about that. We know we've got a lot of factors that are coming up here in the next few months that are going to make the markets potentially go up and down and so forth. Secondly, what should your investment discipline look like on a long term? So what are the long-term disciplines that you should be strategizing for your retirement goals, which for most of you is many, many years out in the future? Should I be actively changing my 401k investments from time to time the market ups and downs? So we're going to talk about market timing and making changes in your 401k plan, whether that's good or bad. What should I know about the November election and how may it affect my investments? So this is obviously front center for all of us. We have news daily about the November election, whether it be the debates, whether it be who has COVID, who doesn't have COVID, and how that's going to affect the election, what policies could be affected, all the way from taxes to spending and so forth. So we're going to talk about the election, which is very, very important here in this next month. What can I do to make sure I'm financially sound with events like the pandemics and job loss? So that one I'm just going to answer straight up here and now. We don't have any additional slides, but the answer is this. We should all be very, very mindful that we know life can throw us some curveballs. Obviously, pandemics are out there. Any sort of accident that you may encounter, some sort of life-changing event, we have to have some cash backup. So the answer to that bullet point is having 1, 2, or 3 months of cash on hand so that in case life throws you a curveball, you've got something to fall back on. So we are going to talk about that a little bit more. I do have one slide to correct myself. And finally, what do my emotions and how do my emotions affect my investment decisions? And how does that affect the short and long-term disciplines that I have for investing? So we're going to talk about some behavioral finance as well. So let's just talk about some of the market topics, some of the news topics that are front center. There's 8 of those. There's obviously more, but I believe what I've listed here are the 8 most important of factors that are going to affect the market in the near term. Obviously, number 1 is COVID-19. Most of us that are on this call are probably working remotely, just as Ian and I are today. And we thank God for technology and the ability to be able to communicate and still educate like we do, and you folks to be productive at work by working remotely. But this was something that was an amazing adjustment we all had to take here over these last 6 months. and obviously the timing for a vaccine. So COVID-19 and a vaccine together are definitely affecting the markets, and we know that. The next point, obviously, is in 4 weeks, we're going to have a presidential election. Most of you that watch the debate, and tomorrow night there's a vice presidential debate. We as Americans are trying to decide, who's best for America moving forward the next 4 years. And a lot of that is going to affect the market. The next round of federal stimulus is also very, very important. So today we just got news this afternoon, as a matter of fact, that there may be delayed talks in the Senate for recommending a second round of stimulus, and the markets were positive at the beginning of the day, and now they're actually winding up in the negative. So we know that 60% of our American GDP is based on small business, and without federal stimulus, there's a lot of small businesses that are hurting. Of course, we know the most affected ones, which are hospitality and travel and leisure, obviously restaurants. Those types of businesses are really, really suffering. So hopefully Congress can get something out sooner than the election, and that's really an unknown at this point. We're looking at unemployment rates. We're obviously tied in with that last round of federal stimulus. We had roughly 20 million people unemployed over the summer. That's gradually crawled back to about 10 million. So we've gotten better, but still fairly high unemployment at 8%. And that's being watched very, very carefully. And that's also going to affect the markets. Estimated corporate earnings, there again, just how are corporations surviving? How are small businesses surviving? And what does the earnings look like? Obviously, earnings turns into growth. Growth turns into your 401k going up in value. So we're very careful to watch what the corporate earnings are looking like over the next 1, 3, 6 months outlook. And subsequently, the last three, China trade, we know that whole topic was hot and heavy at the beginning of the year and largely been set aside now with our relationship with China kind of having fallen off to the side here with the pandemic. Consumer spending is important. Some parts of the economy are doing extremely well. Online companies, all of you probably have ordered from Amazon, and most spending being done online, and we're placing orders to restaurants online, and some of that consumer spending is going on. Companies like Walmart and Home Depot and Costco, some of that spending is awesome, but others obviously for consumer spending in your households is down with the pandemic and staying at home. Last but not least, change in tax policy. So there again, that's part of the election. We know that tax policies change, and that's an unknown as well until we get through the election and see the results from that. So these are 8 very important bullet points. One thing to comment is the stock market does not like uncertainty, and all of these 8 bullet points are points of uncertainty. And hopefully there'll be some clarity in the markets moving forward. And when there's clarity, there tends to be rebound in the market. So we can be thankful, and to be thankful is this point here. We started the year doing really, really well up until March. And March, of course, when the pandemic was announced and everybody stayed at home, we saw a large drop in the markets, and we're going to cover that on this next slide. Ever since March, though, we've had a steady increase. And if you were to check your 401k balances at year end, December 31 last year, and look at it now, it's up. It should be up. Most of you, obviously, are contributing at the same time. We're not counting those dollars. We're just counting the investment gains. We're going to talk about, what the investment gains look like this year. And the fact that most of you are up slightly is really fairly amazing, given the fact that we've got a pandemic, we have social unrest, we have an election. There's just a lot of headwinds to talk about, and yet we're still up slightly for the year in the S&P 500. So that kind of wraps it up. I'll turn it over to Ian to give you kind of a broad outlook of what the last 20 years in the market has looked like.
Thanks, Mark. So previously, if you have all seen some of our previous presentations, we've shown a similar chart like this. This is just highlighting what we've gone through since 1996 with a correction in 2001, and then also the correction in 2007 and 2008. We just want to highlight this by really where we have been and where we are now, and what we also saw in the Q1 Q1, Q2 of this year as well. You've heard in the news just deep V or V recovery. We have seen a V recovery in the markets. Now, that is not indicative of the overall economy as a whole, but in the investment markets, which is normally forward-looking 6 to 12 months on average, we have recovered those losses that we saw from the highs of February 19. And then also we exceeded those highs, back just a couple weeks ago in September. We have pulled back a little bit from that high in September down to where we are as of yesterday afternoon at 34.09 on the S&P index price. So we just wanted to be mindful and show you what we've seen in previous corrections and recessions of a decrease in 50% of market on 2001, 57% in 2007, and then almost 34% in 37%, depending on which index you looked at. But a very large correction in March, and then that quick recovery. I did want to be mindful, if you bought at all points of the market at the lows in 2000 area, the 96, 2001, 2008, and we'll just use 2008 as an example. If you had invested $10,000 in the bottom at 2008, that money is worth roughly 4 times the amount of what it was back then. So $10,000 would turn into $40,000. If you had $100,000 at the bottom of that, it would now be worth $400,000. So the power of investing is really shown here in these ups and downs, but at all points of that buying cycle, if you were adding contributions every 2 weeks in 401k, you're going to do well. And buying when things are on sale is just a constant reminder that we want to go and preach as well too. With this slide, this highlights the S&P 500 as a whole from performance year to date. So the lion's share of the S&P 500 is still underperforming what you see today. So be mindful of what you're hearing on the news. It's not truly indicative that everything is roses. Roughly 80% of the S&P 500 is still in negative territory, or as you can see on this, -6% in that bottom right corner of that chart. The majority, or the lion's share of the actual earnings and performance actually has come from 5 companies in the S&P 500. So literally 1% of those companies are making up 50% of the gains in that index. And you'll see on that far right side, the largest 20% companies in the S&P 500 are making up in upwards of almost 80% of those returns. So be mindful. Just when you see an index going up and there's 20 stocks that are positive, doesn't mean everything else is positive in the world. We have talked about impacts of time in the market and being out of the market and trying to day trade your 401k. This is just a constant reminder that with volatility, there are highs and lows, peaks and valleys in the market. We don't want you to run for the fences or get greedy and try to go really, really heavy into equities or really speculative in certain areas. This is a representation of if you invested $10,000 20 years ago in the beginning of January, what it would be worth at the end of last year. It would be roughly worth $32,000 after that 20-year period of time. And that's with no new contributions. So the money would essentially triple in that 20-year period of time with a 6% return. Now, out of all of those days in the 20 years, market days, if you missed just 10 of those 20 years, you would cut your return in half. And your performance, you see there, it's 2.44%, and that return would be roughly about $16,000, half of what that 32 number is. So be mindful. We want you to stay fully invested through your course of your working career. As you get older in your working career, you'll then decrease your asset allocation and do more bonds versus stocks. And we'll talk about that here in an upcoming slide. I wanted to be mindful in just that gray box on that larger presentation. 6 of the 10 best days occurred within 2 weeks of the 10 worst days, and the best day of 2015 occurred within 2 days of the worst day. So trying to time the market, being right or wrong on the positive or the negative is very, very difficult to do. Please don't try to do it. It's literally impossible. If we were able to do it, if other people were able to do it, we'd be on an island somewhere. So be mindful of that as you're staying disciplined with your investments and also emotions with investing. This does only cover up until the end of last year. I would imagine these slides, as they come out with the newest version at the end of this year, that these numbers will actually be much, much more skewed just with the volatility that we saw in March with the coronavirus. We're going to hop over and shift gears a little bit more in line with the presidential election that we're coming up here on in roughly 4 weeks. The big message that I want to go and preach is no matter who wins, the markets really do not care. They perform well under both administrations, Republican and Democratic. Over the last 75 years, you'll see the president bubbles. The performance is on the left axis, GDP is on the lower axis, and you'll see that there's an even dispersion of Republican and Democratic presidents and their performance from 10% all the way up to the high 20s. And over that long period of time, no one or neither party can lay claim to having a better economic or financial market performance than the other. So be mindful that this election is like really nothing that we have seen before, but at the end of the day, over the last 75 years, the political party that is in charge or has a majority is not necessarily indicative of performance in your 401k accounts or your investment accounts. And to further that conversation, markets do not care if you don't like who's president. I would say we probably can agree that 50% of the time, the approval rating is going to be, not what you want it to be, or it's below the average of that 50 percentile line. And you'll see on this chart on the right-hand side, the Gallup approval poll is on the left-hand axis from 0 up to 100, and they've got a shaded bar between 50 and 35% approval rating. So you'll see that over the course of roughly 80 years, or actually 60 years, sorry, in this case, 60 years from the 1960s up until present day, market performance, the best gains actually happened in that range from 30 to 50% of approval rating. So it doesn't necessarily mean if the president is not liked or is not popular is indicative or correlated to the economy or performance in financial markets. So try to look at this as you may be lucky and get somebody that you're voting for and have the president of your choice in the office or not. But at the end of the day, the markets really don't matter. They don't like uncertainty, but the markets don't matter on the long term of who's in office or who's not in office. I'm going to give it back to Mark here and talk a little bit more about financial wellness and stress of the American worker and a couple highlights.
All right, thanks, Ian. We want everyone at Pax8 to be healthy and wealthy. And really what that means is when you're most productive at work is when you're not distracted by other concerns. Usually they're personal concerns. So we know from doing lots of research that one of the most common sources of stress is, of course, obviously front center is what's going to happen in our country. We're all pretty concerned about that. And almost an equal second is money. And that's why we're here talking to you today. We want to make sure that you're paying attention to your 401k, your after-tax accounts, your other investments, your personal savings accounts, because we know that if you have all of that satisfied and taken care of and you're doing what you can, you're doing what you're supposed to, you're going to be more productive at work. So that's really kind of some notes of common stresses is in that box on the right-hand side. On the left-hand side box, I'll just share a few of these statistics. And most commonly, they all revolve around one common theme. And it's really presented in one of those middle bullet points. And that's 4 in 10 adults said they can't afford an unexpected expense of $400 without selling something or borrowing money, or i.e. using your credit card. So that's a pretty, it's 40% basically. So that means, 4 of 10 of you on this call are in this bucket. Maybe it's you, maybe it's not. But again, just be mindful and recognize that. And if you are one of these individuals, make sure to have that emergency fund set up. And that's just super important. So that's really, financial wellness is so key. And we just know that you're going to be more productive at work if you've got things shored up at home. So let's talk about behavioral finance and the emotions of investing. We talked a lot about in earlier slides some of the things that have emotionally been affecting us. Obviously, COVID's affecting our households. We know that the election's affecting our households. We can't even talk to anybody about politics. And a lot of these things revolve around how we invest our money. It's our behavior. Are we positive about the markets? Are we negative about the markets? Um, are we making decisions based on emotions? Now, Ian and I would tell you that the less emotion in your investments, the better, right? So, and that's why we exist. That's why we want you to call us. We want to make sure that when you do make investment decisions on your portfolio, that we can do so without the emotion behind it and walk you through more of the academic side of your investments. So at the end of this presentation, of course, you're going to have our phone, you're going to have our email, and an offline conversation. If you so choose to call us, we can look at your 401k accounts and have view access at Voya Financial. And that's going to be a point where we can log on and see your investments and do a real good check on your holdings, whether you're in target date funds in your 401k, or if you are following our investment guide, which we're going to show you here shortly, or if you're picking investments on your own. We're going to be able to weigh in on giving you some advice. So getting back to behavioral finance, there's about 8 of those listed on here, and I'll just talk about a few of them. And as we analyze what goes through people's minds when it comes to investing, one of them, of course, is fear of loss. Studies show that the pain of losing money is twice as more painful as earning money. So the example I always like to share is if you found a $20 bill, you're pretty excited. You're not going to write any letters to anybody or send anybody any tweets. You're just going to move away with your 20 bucks and be happy. But if you lost $20, that's going to really upset you. And to the extent of twice the emotional effect of losing that 20 than gaining that 20. Confirmation bias. This is basically just meaning that we're strongly influenced by what we are currently experiencing, whether it's the news, a current conversation, anything that's been recent or traumatic. And so we typically make decisions based on, something that's very, very current. And sometimes we avoid red flags. We avoid somebody telling us that what we heard wasn't true. We just have to be open-minded so that we don't wind up in confirmation bias. Herding is super popular. We've all heard of our parents maybe used to say, look, if somebody was going to jump off a cliff and you really like that person, do you jump off the cliff with them? Well, the answer is no, but we tend to do what other people are doing. If somebody's, going somewhere and there's a big group going somewhere, we tend to go with them, right? And that tends to affect our investment decisions as well. We tend to invest how other people are investing. And sometimes that's not always the best thing for you personally. You have to make those investment decisions based off of hurting or not hurting, based on what's best for you. And of course, present bias is the overvaluing of the immediate reward. And that really extends into the fact that we live in an immediate gratification society. We're always, wanting to do the latest and greatest or have the latest and greatest things. That may not always be best for you on the long-term perspective. So again, investing is very, very emotional. We want to make sure that you're doing the right things. So on this next slide, we're going to show you a little bit about diversification, which is super, super important when we look at your 401k investments. On this particular slide, we're going to talk about stocks and bonds. And in a normal 401k, you're going to have all your investment choices. And yes, you do in your Voya 401k. You have lots of pure stock investments. You have pure bond investments. What we recommend is to have a mixture of both. And a lot of it depends on your age and your risk tolerance. For those of you on this call that are younger, you're going to be more aggressive because you have the time to withstand all of this market volatility that we showed you earlier, all of the bull markets and bear markets, and what we call basically all the gaining years and all of the loss years. And when you put money into your account every 2 weeks from your 401k, all of that averages out over the course of time, and you basically are checking your emotions. You're getting through that, and you're staying the course. You're doing the right thing from a discipline standpoint. So one good key measure or say guideline that I can give to you for financial advice today is to take the number 100 and minus your age. So and that would be your stock bond mix. So if you're a 40-year-old individual, you would take 100 minus 40, which is 60. 60 becomes the amount of stock you should have in your portfolio, and 40% becomes bond. If you're 20 years old, you would be 80% stocks, 20% bonds, and so forth. So this chart gives you a great view of what you can expect for market returns and what the volatility is. The annual return based on long-term averages since the last 25 years is on the left-hand side, from 0 all the way to 11% in growth rates, or say expected returns, annual returns. The bottom axis is the volatility, meaning that's the ups and downs in the market. Think of a heart monitor when it bleeps up and down when your heart pumps. So obviously with 100% stocks, you can potentially gain the most in annualized return. But if you look at the bottom scale, you can also expect the most volatility of ups and downs. And as you scale back towards the left and introduce more bonds into your portfolio based on your risk palette, your age, and all these things that I just mentioned, you gradually do reduce some of the expected annualized return, but you greatly reduce the amount of volatility that's in your portfolio. And so anyway, we want to have bonds in your portfolio. We want to have stocks in your portfolio. You determine what that correct mix is. And we have, of course, investment strategies for you to follow based on the allocation guide that we typically send out every quarter. So Ian, are you there?
Yes, I am here. Sorry, I was just on mute for a second, but thanks for bringing up the asset allocation guide, Mark. As just a reminder to everyone, the newest version of this will be out in roughly 2 weeks. We get our investment numbers roughly next week on the 15th of the month, and we'll be doing our analysis on that and making adjustments and tweaks to the allocation guide. As a reminder, the hands-on version is going to be that top larger rectangle with the percentages, and then the hands-off is going to be the target date funds. Again, it depends on how you want to go and manage your money. There's not a right or a wrong. It's more hands-on or hands-off. And the third is you're free to do whatever else you would like as well. We welcome any calls around this. We'll have our online communication come out to you roughly in about 2 weeks with this guide with some other investment help as well. With that being said, we just wanted to talk one housekeeping item. We have gotten a series of calls throughout the last 6 months just with people getting a hold of their finances and having a little bit more free time to look at where things are at. And that's brought up a lot of questions around rolling over monies and keeping track of what you have. If you have an old IRA or an old retirement plan with a previous employer and you're looking to consolidate that or move that over to the Pax8 401k plan, it is available. You can do that by contacting your old provider and having them send a check to Voya accompanied with this form here. If that does apply to you or you have any questions around that, feel free to reach out to us. Voya's participant services line, if you need any questions on or have any questions on the website, any forms, that 1-800 number there is a great resource for you guys as well. With that being said, we're going to be mindful of your afternoon. We're hitting right at the half-hour mark. If you have any questions, feel free to chat us in the little chat box here. Also, shooting us an email or giving us a call is totally available as well too. We've already had a few participants from our last meeting earlier this morning with your other colleagues, work colleagues, set up some one-on-one time. So we welcome any calls, emails. Feel free to reach out to us with any questions and hope you all have a wonderful rest of your afternoon. And thanks for your attention today.